After the big bailout of Yes Bank and IDBI Bank by SBI-led consortium and LIC, there is now a need for creating an institutional framework for dealing with restructuring and insolvency in the financial services sector. The Financial Resolution Corporation is much needed to identify the weakness in banks, NBFCs, insurance companies and mutual funds and take timely action like restructuring, merger and even suggest liquidation if there is no resolution in sight. 2 years ago, the government brought a financial resolution and deposit insurance bill in the Lok Sabha for dealing with bankruptcy in the financial services sector, but it was withdrawn because of political pressure. There was an opposition to the bail-in clause of using the depositors' money for settling liquidation claims. There is already an institutional mechanism for handling corporate insolvencies. The Insolvency and Bankruptcy Code, or the IBC, for the corporate sector is already stabilizing in the market with amendments and precedents set by the courts. Is it time now to reintroduce the FRDI bill to create a separate resolution mechanism for dealing with failures like Yes Bank and IDBI Bank? SBI Chairman Rajneesh Kumar recently posed this question to the RBI Governor in a public forum. The RBI Governor responded positively by batting for a resolution corporation but with proper legislative backing. The Finance Minister Nirmala Sitharaman recently said that the government has started the work on the bill again, but she was not sure when the government will reintroduce the bill. The need for Financial Resolution Authority is being felt more because of multiple reasons. There is a growing large private sector in the financial services sector. Given the government's finances, it will not come forward to bail out any private sector firm with taxpayers' money. This was something the market saw in the case of Yes Bank, where the banks led by SBI pumped in over 10,000 crore to rescue the bank. In a similar case of IDBI Bank, the LIC was asked to rescue the public sector bank. LIC had to infuse over 30,000 crore to rescue IDBI Bank. The private insurance companies are also very big today. They command a 30% market share in the life insurance business and a dominating 60% market share in the general insurance business in terms of total premium. The mutual fund industry is also dominated by the private sector like HDFC and the ICICI Mutual Fund. UTI Mutual Fund, which was bailed out by the government after the failure of US 64 scheme in early 2000, is down to 6th position. The NBFCs have also grown bigger. A large NBFC like ILFS with over rupees 1 lakh crore of balance sheet size was left to fend for itself when it faced asset liability mismatches. Another big NBFC, Diwan Housing, is facing insolvency proceedings. The events of failure of financial services companies will definitely rise in future. In many of these private companies, there are small investors as depositor and saver. So who will bail them out? LIC and SBI cannot be a proxy for the government or the lender of last resort for saving the private sector enterprises. Under the current regime, RBI has the prompt corrective action framework for monitoring the weak banks and devise the resolution strategy. But the RBI doesn't have power over PSBs to initiate a merger or liquidation. The RBI cannot even sack or supersede the management or the board of the PSBs. The NBFC sector is already under IBC regime, but the RBI has the power to invoke liquidation proceedings against NBFCs. So far, the RBI policy is to merge a weak bank with a healthier or a stronger bank. But any such merger pulls down the profitability of the large institution. The interlinkages amongst the financial institutions like banks and NBFCs or NBFCs and mutual fund and insurance creates a bigger risk of spillover. ILFS is a recent example where the collapse of the institution impacted the mutual fund industry. The biggest criticism the FRDI bill faced was about the bail-in clause. Under the waterfall mechanism, the depositors were standing at the 5th position in the queue. The first were the insured depositor up to rupees 1 lakh per depositor. This deposit insurance limit has now been raised to rupees 5 lakh. This will surely act as a protection for depositor under the FRDI bill. The larger purpose of having a resolution authority is for acting in a timely manner and doing a restructuring to save the institution. Beyond banks, there are NBFCs, mutual fund and insurance companies where small savers' investments are parked. A dedicated resolution corporation could go a long way in providing a comfort to all the stakeholders that their money is safe.